Look at a stock ticker on any given Tuesday, and you'll see a chaotic blur of red and green numbers. It looks like gambling. But beneath that flashing board sits a physical, operational business. In the markets, the daily price is a fact, but the actual value of that business is simply an opinion. Buying a share converts your capital into a literal slice of the business. This slice entitles you to two specific rights: a say in corporate decision-making through voting, and a residual claim on the company's actual assets and profits. As an owner, you reap the rewards of the operation. If the business succeeds and expands, your slice grows in value over time. That's capital appreciation. The company will also frequently distribute a portion of its profits directly back to you as cash dividends. But ownership means absorbing the blows when things go wrong. You are exposed to market risk, where a macroeconomic shock drags down every asset, and sector risk, where a new regulation or technology disrupts your specific industry. Then there is company-specific risk. A CEO makes a terrible acquisition, or a supply chain failure destroys a quarter's earnings. Because thousands of traders are constantly reacting to these overlapping risks in real time, the public market price whipsaws wildly from day to day. That daily panic heavily distorts the sticker price you see on your screen. To cut through that noise, serious investors rely on a separate, objective mathematical framework to calculate what a business is actually worth, regardless of what the ticker says. This funnel visualizes the first step of that framework: fundamental analysis. The process starts by looking at the broad global economy, filtering down to the most promising industries, and finally isolating a single, highly efficient company at the bottom. This is the EIC approach. Once you isolate that target company, you have to estimate its intrinsic value. The most reliable mathematical tool for this is discounted cash flow, or DCF. The logic is straightforward. A company's current worth is equal to all the future profits it will ever generate, translated back into today's dollars. This timeline illustrates the dividend discount model. If the company pays a regular dividend, we project all those future payouts along a timeline. Then we pull them back to calculate what that total stream of future cash is worth to us right now. If the company reinvests its money and doesn't pay a dividend, we use the free cash flow models. We project the total operating cash the business will generate internally and anchor that entire flow back to a present-day value. Because the future is uncertain, we have to discount those projections. We reduce the estimated value based on the stock's historical volatility, a risk metric known as beta. A highly volatile stock gets heavily discounted to account for the extra danger of holding it. This calculation establishes a rigorously derived estimate of intrinsic value, a mathematical opinion that serves as a concrete financial anchor against the volatility of the market grace. You can also double-check your math using relative valuation. Instead of projecting decades into the future, you compare the company directly against its closest competitors to see if it's trading at an unusual discount today. This scale visualizes the price-to-earnings ratio. It tells you exactly how much you are paying for every single dollar of profit the company generates, making it easy to line them up and spot the cheapest business in the sector. If those competitors have different levels of debt, investors use a multiple called EV to EBITDA. It strips away the complex financial structures and compares the companies based purely on their raw operational profitability. Now, there is an alternative school of thought that considers fundamental analysis a waste of time. They are technical analysts. These chartists operate on the assumption that all the economic data, the earnings, and the risks are already reflected in the current stock price. To them, calculating intrinsic value is unnecessary because the market has already done it. This chart tracks a stock's historical price and volume moving sideways. By drawing floors of support and ceilings of resistance, chartists map the psychological pressure in the market, waiting to trade on a sudden upward breakout. It comes down to what you are trying to capture. Fundamental investors dig through financial statements to extract hidden economic value. Technical traders study the charts to exploit human psychology. For the fundamental investor, the trigger to buy occurs when your calculated intrinsic value is significantly higher than the current market price, flashing on the screen. Once you buy, the strategy becomes an exercise in patience. You hold your shares and wait for the market to eventually recognize the underlying cash flow of the business and bid the price up to match your valuation. But even the best systems have a vulnerability. Sometimes your growth projections are too optimistic, or your intrinsic value calculation is just flat out wrong. You protect yourself through cross-sectional diversification. By spreading your capital across different, uncorrelated industries, an unexpected collapse in the tech sector won't sink your holdings in healthcare or utilities. You construct a portfolio built to weather the storm. You combine that with time diversification. By committing to hold these assets over multi-year market cycles, you mathematically smooth out the extreme highs and lows of daily trading panics. Equity investing requires the disciplined calculation of real business value and the systematic exploitation of market errors, all shielded by diversification to build lasting wealth.